Dear students, this video will cover interest rate swaps. It's a very exciting area to study and learn about. This video will cover interest rates and currency swaps. Two websites that I recommend you to go and take a look at is first isda.org and biz.org. ISDA focuses on swaps and derivatives markets. Their mission is to foster safe and efficient derivatives markets to facilitate effective risk management for all users of derivative products. They help educate the associates of investment banks. Bank International Settlements was founded in 1930 by 62 central banks around the world. Together, they account for about 95% of the world's GDP. They have their headquarters in Basel, Switzerland, and have two offices around the world, and one is in Hong Kong and the other one is in Mexico City. Their mission is to foster discussion and facilitate collaboration among central banks, supporting dialogue with other authorities that are responsible for promoting financial stability, carrying out research and policy analysis, and also issuing relevant decisions for monetary and fiscal stability. They also act as a primary counterpart for central banks in the financial transactions part of the world. They also serve as an agent or trustee in connection with international financial operations. The main goal is financial stability. Swap banks is a generic term to describe a financial institution that facilitates swaps between counterparties. The swap bank can serve as either a broker or a dealer. As a broker, the swap bank matches counterparties but do not assume any part of the risk. As a dealer, the swap bank stands ready to accept either side of the currency swap and then later try to offset this risk by finding a match that matches this counterpart. Swap banks will tailor the terms of interest rate and currency swaps to a customer's need. They also make a market in plain vanilla swaps. That's standard contracts. And they provide quotes for these contracts. Since the swap banks are dealers for these swaps, they actually make their money on a bid-ask spread. The most common currency swaps are US dollars, Japanese yen, euro, Swiss francs, and British pounds. Here's an example of how quotation might look like. Here's one for the euro, where they have a bid-ask spread on the 10-year, and it will be 3.82 and 3.85. So the spread in between here is the money that they actually make. In a swap, two counterparties agree to a contractual arrangement where they agree to exchange cash flows at periodic intervals. There are two different types of interest rate swaps. One is called single currency interest rate swap, also known as a plain vanilla. Fixed for floating swaps are often just called interest rate swaps. Another one might be a cross-currency interest rate swap. This is often called a currency swap, where fixed for fixed rate debt services in two or more currencies. Assume that an investment bank has two clients. One is Ford and the other one is Sony. In the United States, Ford can borrow at 5%, where Sony can borrow at 8%. Now, on the other hand, in Japan, Ford can borrow at 9%, where Sony can borrow at 7%. Now, in this case, Ford is planning to expand their business in Japan, and Sony wants to expand and build a new factory in the United States. They would like to avoid taking currency risks, so they're looking at how could they actually do things at a lesser cost and a more stable risk. So both Ford and Sony talk to the same swap bank, and they offer an arrangement. Now Ford needs $100 and Sony needs $200. So Ford goes and borrows the money that Sony needs in the United States. So they borrow the $200 from Bank A, and they send this through the investment bank, who makes sure that Sony receives the $200. Now, in Japan, Sony will borrow from Bank B $100, and they will, through the investment bank, send $100 to Ford. Now, Sony can borrow at 7%, and Ford can borrow at 5%. They're both better off. So when it's time to pay the cost over in Japan, Ford will send over $7 to pay Sony to honor this debt. Likewise, Sony will send over $10 to pay for the loan that Ford borrowed. Naturally, the investment bank will earn some fees as well. But here's a simple example of how it works. Sony can borrow money and engage in business in the United States at a lower cost, and Ford can do business in Japan and borrow money at a lower cost. There's a win-win situation, and the third winner is naturally the investment bank that actually helps arrange this settlement. Now, naturally, there are lots of risks involved with swaps. One is credit risk. This is a major risk faced by a swap dealer, where the risk that a counterparty will default on its end part of the swap. Now, that's a risk that the investment banker takes. A mismatch risk is that it might be hard to find an exact match for the exact amount of money. So because it's hard to find a counterpart that wants to borrow the right amount of money for the other part of the loan, it might take a little bit of time. Sometimes it has to be divided on 2 or 3 other clients. Sovereign risk is that is involved that a country will impose exchange rate restrictions that will interfere with the performance of the swap. Here's another example of a currency swap. Suppose that an American multinational corporation wants to finance a 10 million pound expansion of a British plant. They could borrow dollars in the US, where they are well known and can exchange for dollars for pounds. This will give them an exchange rate risk, and that kind of financing of a project where they convert dollars to sterlings. They could also borrow pounds or sterling in an international bond market, but pay a premium since they're not as well known abroad. If they can find a British multinational corporation with a mirror image of their financial needs, they may both benefit from a swap. So if the spot exchange rate is $1.60 for pounds, the US firm needs to find a British firm that wants to borrow or needs roughly $16 million. Now, typically companies don't walk around and find companies having those needs. That's why they would turn around and talk to an investment banker who will help them with this transaction. So assume that company A and company B is able to do business together and figure out how to put together a swap. Company A is based in the United States and company B is located in the United Kingdom. Both have a project that are equal in size. Now, in this case, company A can borrow at 8% in US dollars, or in British pounds, their interest rate is 11.6%. Now, company B, on the other hand, can borrow at 10% in US dollars, or borrow actually at a 12% interest in sterling. Now, in this case, both companies both companies have comparative advantages. Company A has a comparative advantage borrowing in US dollars, right here, and company B has a comparative advantage in borrowing in pounds. I had a little mistake here, so I had to edit that. If they borrow according to their comparative advantage and then swap the interest rates, they will both gain from doing business with each other. So, the comparative advantages are such that A pays 2% less to borrow in US dollars than B, and B pays 0.4% less to borrow in pounds than A. To explain how this all works, we'll look at quality spread differential. The quality spread differential, or QSD, represents the potential gains from the swap that can be shared between the counterparties and the swap bank. There's no reason to presume that the gains will be shared equally. In the above example, the company B is less creditworthy than company A, so they will probably have to get less of the quality spread in order to compensate the swap bank for the default risk. So, explaining this in a different way, firm A has a net position to borrow at 11%, right here, and firm B has the ability to borrow at 9.4%. So the example here is that firm A will have the cash flow at 11% going in and 8% coming back, where the swap bank will manage this risk by having the 12% flowing to B and 9.4% flowing to the swap bank. That way, this risk is managed, and firm B will then have the cash outflow of 12%, and firm A will have the cash outflow of 8% over here. Now, I want to remind you that firm A needed 10 million pounds and firm B needed $16 million. It's important that you keep track of the exchange rate of $1.60 per pound. So keep things simple. Firm B will actually save a 60 or 0.6% in dollars, whereas firm B will actually save 0.6% in British pounds. The most important part of this lesson is to remember that swap banks can help you save money. Dear students, I hope you liked this video. If you did, please subscribe by clicking up here and give me and maybe even write a little comment down below. So I appreciate your help and your support, and I hope you enjoy these videos on finance.